Good afternoon, everybody. I have that coveted after lunch time slot on a Friday afternoon in sunny San Diego. So thank you, everybody, for taking time out to be here. I'm Greg McBride. I'm with Bankrate. And you probably know Bankrate for all of the rate and fee data and our award-winning editorial content. But one of the other things that we've really been doing a lot of, particularly in the last 5-6 years, we've really taken a deep dive in terms of doing a lot more consumer polling. Getting a lot of data, just kind of hearing from the voice of the consumer in terms of financial issues they're contending with, what the financial mindset is at any particular point in time. Do about 2 polls per month. These are actually conducted on our behalf by an outside research firm. So when your phone rings at dinner time, be sure to answer and answer all the questions. We really started this late 2010, early 2011, and that was the very early stages of the economic recovery before people were really comfortable calling it an economic recovery. And at the time, the one thing that was really evident from the very beginning was that the majority of Americans felt that their financial situations were still in a deteriorating state. Only the top third of income-earning households said that things were getting better at that point in time. We moved into 2012. And we saw that not just the top third of income-earning households, but now the top half of income-earning households, anybody above median income, said things were getting better. Their financial situation was improving, and we were seeing this on a variety of different fronts. As we moved into 2013, then lower middle-income Americans started to say that, yes, they too were seeing their financial situations starting to improve. And that's been a very consistent reading that we've gotten month in, month out ever since. Not surprisingly, the lowest income households are the only ones that, even to this point, aren't consistently at that point where they feel like their financial situation is on the way up. We do see occasional hints of improvement and optimism, but not to the same level of consistency that we see among other income groups. But even there, the feedback we're getting from even the lowest income households is considerably better today than we had seen in prior years in earlier stages of the economic recovery. Now, what this data does is it also gives us the opportunity to kind of dive a little bit deeper and take a look at more of a demographic level in terms of what we're seeing. And so, in particular, we have a lot of data with regard to millennials. And for whatever reason, the general consensus is it paints millennials in a bad light with regard to their finances. But I have to say the data does not support that. It actually tells us a very different story. We actually see a lot of positive indicators with regard to millennials and their finances. They have the highest levels of job security of any age group. In that, makes sense. They have the technological skills, the social media skills that employers crave. They have a greater inclination towards saving than we have seen in previous generations. More than 6 in 10 millennials is saving more than 5% of their income. That's more than any other age group. They're the only age group that says that they actually feel like they're making progress with regard to savings. Savings is something I'll come back to in a few minutes. But a lot of positive indicators there. And then, albeit coming from a small base, millennials consistently say that their financial situation is improving, and with far greater consistency than we see from other age groups. So a lot of positives there. They're also less consumption focused, have more of an aversion towards debt. So I think when you put that together, the greater inclination towards savings, less of a consumption focus, more of an aversion to adding debt, those are positives not only for their financial situations today, but also, I think, solid building blocks for the years ahead. When we poll Americans in terms of their top financial regrets, the things that bubble to the top are not saving for retirement early enough, not having enough emergency savings, that too, something I'll come back and touch on, followed by regrets about too much credit card debt, too much student loan debt. I think it's interesting that the biggest regrets that people have financially have more to do with the not saving than they do with the debt that's piled up. Again, I think that's contrary to how a lot of people characterize it. You often hear people talking about the overly indebted American, but in reality, we've seen that Americans have actually gotten a much better handle on their debt in recent years. It's the savings where the needle really hasn't moved. When we look at those regrets on a more demographic level, for example, student loan debt. Not surprisingly, it skews overwhelmingly toward a younger crowd. And you see that over time, those regrets about student loan debt decline and eventually disappear altogether, much like the debt itself. Whereas the regrets about not starting to save for retirement early enough, they only grow with age. And so my first public service announcement of the day is going to be that, for young people that are focused on student loan debt and paying ahead on that as much as they possibly can, don't do so if it's going to mean compromising the savings goals. I have seen it too many times where people say, I'll start saving as soon as I get out of debt. And then what happens is it takes 10 or 20 years to get out of debt before they start the saving. So as you can see, if you wait 10 or 20 years before you start the retirement savings or any other savings, then you're going to be in a much bigger hole that has to dig out of. So, particularly with federal student loans that carry low interest rates, the possibility of tax deductibility, deferment and forbearance if you run into financial difficulty, income-based repayment, even debt forgiveness in certain cases, that over time that debt will take care of itself. Don't compromise the ability to save and utilize the power of compounding. Don't jeopardize those savings goals in an effort to pursue debt that, quite frankly, it's going to take care of itself over the course of over a 10 or 20-year repayment period. I mentioned savings really kind of being the Achilles heel, if you will, of financial security. It's the one area where people really haven't made progress. And I'm not just saying not consistent progress. I mean not making progress. We've seen this over the course of several years. For example, only about half of Americans have more money in emergency savings than they do in credit card debt. And that is a metric that has not improved over the years, even as people got a better handle on their debt. So, it just goes to show how far behind a lot of people are with regard to their savings. As for that all-important emergency savings cushion that we need, only a little bit more than 1/4 of Americans actually have a sufficient cushion, enough to cover 6 months' worth of expenses. An equal 28%, same percentage, about 66 million adults, don't have any at all. No emergency savings at all. And about 1 in 5 working Americans is not currently saving any of their income. What we've also noticed is this is not the spendthrift American of 10 years ago who felt like they didn't need to save. No, when we ask people, why aren't you saving more? Top answer is the stagnant income has been the barrier to doing so. We ask people, well, why aren't you spending more? Because again, it's not like this is a spendthrift consumer. This is a consumer that wants to save. What are the obstacles to doing that? People aren't spending more either, and they say, again, stagnant income and then also the need to save more. So again, we've seen a real reprioritization in terms of savings. The obstacle for so many people has been that they just haven't had the wiggle room. They haven't had the latitude to really boost the savings because their incomes haven't gone up. Over the course of the last several years we've been doing this polling, and as testament to that, when we talk to people about their household budgets and their financial priorities, 40% of Americans say that their top financial priority is just staying current or getting caught up on the bills. So again, household budgets are tight. Those incomes really hadn't gone up for years in succession, and so people really didn't have breathing room in order to really ramp up savings in a significant way. Now, it's not all doom and gloom on the savings front. We find that about 28% of Americans are saving more than 10% of their incomes. Now, that's the same 28% saving more than 10% of their incomes. 28% also have 6 months' worth of expenses and emergency savings. There is a very high correlation between those groups. And you might think that, that definitely skews toward the highest income groups. Not entirely. In fact, we found that it was pretty much the same, 27% for lower middle income Americans. Households with income between $30,000 and $50,000 a year, 27% of them are saving more than 10% of their incomes, proving the old adage that it's not how much you make, it's how much you have left over. So, and also I think, again, a testament to the prioritization that people put on savings. We've also seen improvement in other areas. In terms of people increasing their retirement savings contributions, it is higher this year. More people have increased their retirement savings this year than we've seen in any of the previous 5 years that we've been looking at this. And conversely, those that aren't contributing to the retirement savings is the lowest it's been in those 5 years. So, that's consistent with, and you may have seen some of the figures from the Census Bureau just a couple of weeks ago that showed that household income is finally starting to increase on a more broad-based basis, and it was the biggest increase in the last year than it had been in any year since at least 1968 when they started tallying that. So, a very positive indicator there that income's finally on the way up, and we're also starting to finally see the needle move a little bit with regard to their savings. Now, the fact that people are saving is a good thing. Problem is how they're investing that savings, particularly the money they don't need for a long period of time, is an entirely different matter. When we poll Americans on their long-range investment goals and what they think is the best vehicle to get them to those long-term investment goals, you'll see that the stock market is a distant third. And that is no fluke. It's been that way every single year. People have not warmed up to the stock market at all, despite the fact that it has rallied. We've surveyed this over the course of several years, and we've seen, the market goes up 20%, and yet in terms of people's preferred long-term investment category, it doesn't even move the needle. The stock market has consistently been third or fourth, and very distantly so, every year that we've been surveying this. At the top of the list, as you see there on the far left, real estate. That is Americans' preferred investment vehicle for money that they wouldn't need for more than 10 years. Can't find fault with that. But you'll see that a close second is cash. Cash being the second most commonly cited investment, preferred investment for long-term goals. Just, I think, a real testament to how squeamish about risk the individual investor remains, despite what's now one of the longest bull markets we've ever seen. When we look a little bit deeper in terms of some of how this breaks down demographically, the preference for cash in terms of long-term investments is highest among, any guesses which age group has the highest preference for cash? It's millennials, and it's younger millennials, those between the ages of 18 and 25. They actually have the highest preference for cash, for money that's not going to be needed for more than 10 years. And that's troubling because this is a group that, it's good that they've got the memo on how important savings is and they've prioritized it, but this is a group that's going to have the biggest retirement savings burden of anybody, bigger than anybody that's preceded them. And they're not going to get there by hunkering down in safe haven investments. In terms of real estate, as you see there, it is the top investment choice. What was interesting is that we did not see that one skew by age. It was basically the same for everybody from age 26 to age 70. It was virtually the same reading across the board. So for all the concern and angst that people have about millennials not buying homes, I offer that up as evidence that they may not be buying now, but they will buy. That they do view that as a viable avenue for wealth creation. So a lot of the millennials that aren't buying houses today, it's not because of a soured view about real estate. It's because they are building their careers in their early years. They need that career mobility to jumpstart the earnings. And then eventually going to help them buy that house. And they're going to skip right over the starter house. They're going to go, by the time they, get into their mid to late 30s, they're going to want a place in the suburbs with a backyard and a garage. And that's where it'll be. I mentioned how, millennials have a greater savings mentality than we've seen among previous generations. A lot of that comes from having a front row seat to the financial crisis. They saw the impact that had on their parents, older siblings, family members, friends that lost jobs or that saw their net worth decline dramatically. Another interesting point is that millennials are actually more likely to have emergency savings than their counterparts in Gen X. Gen X, those are the prime, kid-raising, tuition payment-making years, and yet they are less likely to have any emergency savings than their counterparts among the millennials. So again, I think you're seeing a lot of the building blocks among millennials that will eventually pay dividends. I think even more so than what you're seeing now. One of the things that we've noticed, just recently, we've said very consistent readings among consumers in terms of their financial security improving, getting a better handle on their debt, people's net worth on the rise. Even if they're not directly invested in the stock market, those that own real estate have seen the value of their homes rebounding. But those that are in 401k plans or have IRAs, they're seeing the stock market bring the values of those up. Net worth, by about a 2-to-1 margin, people say their net worth is more likely to have increased rather than decreased over the last 12 months. So, a lot of positive indicators there. The one thing we've noticed more recently is that, people are starting to getting a little bit of agita about the election. They actually view it as the biggest risk to the economy over the course of the next 6 months. More than 60% of Americans, and it was very consistent. I mean, didn't matter. We looked at all the demographic data in terms of age group, income group, gender, political affiliation, you name it, and it was very consistent across the board. So that's something that's starting to undermine some of those areas of strength we've seen, and in particular, comfort level with debt. People all of a sudden starting to get a little queasy with regard to debt, as you've seen. Student loan debt in aggregates at $1.3 trillion, auto loan debts at $1.1 trillion in aggregate, and revolving debt, credit card debt, is inching its way back up toward those 2008 levels. It's currently knocking on the door of $1 trillion in aggregate debt. So, we'll have to see how that shakes out. What worries people at any one point in time, we do notice it does change and can change very dramatically. At the beginning of the year, 40% of Americans said they were concerned about rising interest rates this year. Well, interest rates haven't increased, and now people aren't so worried about it. So, those concerns that are weighing on people today, particularly with, regard to, say, the looming election, those are the type of worries that are going to be alleviated in large part over the next few months. So, it doesn't necessarily mean any kind of turning point, but it is an interesting fact that we'll nonetheless be keeping an eye on. So, just, to recap broadly, we have seen over time, over the last 5-6 years, a very consistent improvement in terms of how people feel financially, their comfort level with debt, their net worth, feelings of job security, all of that, I think not only tied to the improvement in the economy, but in some sense responsible for it. And then millennials in a much better financial position than they're given credit for, and a greater inclination towards savings, not the consumption focus that we see among others. Savings continues to be really the Achilles heel of personal finance. That's the one area that to date hasn't shown much improvement, but the positive indicator going forward is that recent jump in household income that is more broadly based and will give people the ability to finally make some headway on savings to reflect the greater prioritization that they've given. And as investors, Americans are still very risk averse, still preferring, as you see, cash to a much greater extent than certainly than the stock market, and almost rivaling real estate in terms of those long-term investment goals.